Chase my dollars and make it hurt.
Hey guys, welcome to the episode of Let's Talk Commercial Real Estate Investing, the Black Community Edition, Education Wednesdays. I am your lovely host again. Thanks for tuning in. I am Dominic Green, currently managing partner at Tentacle Commercial Real Estate Services here in the DFW area. And today I want to kind of talk about senior housing. Last episode, I told you guys I'll do, a little due diligence or some insight or some research on the senior housing industry, what's going on, opportunities and stuff like that. Especially when we was having a conversation about, or at least my thoughts on how this Delta variant is going to have an impact. So when you start listening to the guys that's in the senior housing industry, a lot of them said that, let's backtrack that. The senior housing industry or segment has different niches in it, right? So you have your age restricted, you have your independent, assisted living, memory care, and then your skilled nursing or, nursing homes. And then obviously, at that point, after that, it's hospitals. But each of them are different. Remember that senior housing is one of those businesses that, depending on what niche you're in, is very labor intensive. Especially if you're getting into like the memory care and skilled nursing, and assisted living. A lot of those, most of that is they have to be licensed, it's regulated. So in those cases, you have instances where you have kind of like almost like hotels, right? You have the real estate, then you have the operator. Well, in this case, you have the kind of same thing. You have the people that own the actual building and real estate, and they have an agreement with a specialized operator who has experience in operating these type of facilities for this segment of the population or this segment of the customer base, right? So that's how most of those models are situated. Some have it all in-house. For me, I kind of looking at the whole independent, affordable aspect of it, because there is, like I told you, maybe I don't know how many episodes ago when we talked about this, where a lot of the new development is for private pay, and it's for a reason. Those people have assets, they have the money to actually pay, because especially when you get into your assisted living elements, memory care, the expense per year is drastic, right? So as opposed to somebody paying, let's just say, call it $1,000 a month to live with a traditional conventional apartment, maybe independent, age restricted. When you start getting into the more assisted living, because the person needs more services, because of the elements and stuff that they're facing with, it becomes more costly. So you can start getting into instances where people are paying, almost, I think the average in those facilities, I think on a national scale, it's probably about $4,500 a month, up to maybe $6,000 a month, and it varies on the level of service that people need. So, when we talk about this whole affordable thing, especially when we talk about seniors, a good majority of them don't have the assets, the income to actually pay for that, right? So obviously developers are looking for, the less risk and the best opportunities. Thus you get them building more of the private pay, people that have assets, and they're typically, And this just goes to the fundamentals when you're looking at whatever spectrum you're going to be on, because all of it's going to depend also on their children, right? What is the income levels of the children? Because a lot of times, people paying out of pocket. You don't have a lot of government assistance other than, HUD, but you got to be, low income and stuff like that to actually qualify for any of that assistance. So, a lot of it's going to be out of pocket pay, right? Depending on the family, the support. So how much do they make? In conjunction with, how many seniors are in a particular area, 3 to 5 miles, you would say. What is their level of income independently? What is their assets? So those guys are looking at anything from, incomes of 100,000 plus, home values, and the 300 plus, because a lot of seniors, when they decide to leave, sell their homes. So obviously they're looking on the higher end of the spectrum for those who can have probably more equity in their homes to actually pay for their living expenses and costs of living at these locations. But not to get too sidetracked, a lot of facilities, both for profit and non-profit, according to what I was listening to, maintain occupancy on the other side of the spectrum, which is closer to the independent and somewhat assisted. But the people that obviously were hit hard were your skilled nursing, right? Because COVID, you can only have so many people per room. The procedures, people being vaccinated, outbreaks happening, and then with parents, that parents, but the children being scared for their parents. Some of them pulling them out and just bringing them home. You know what I mean? So that affected a lot of occupancy with those particular type of products. But obviously, just stuff like that presents opportunities. But again, I'll hint back at this is going to be even more specialized, right? Like when you get, it's like I said, looking at hotels where you're going to have it's specialized. You have the operations, you have the real estate. You got people that actually are in the business of hospitality and the real estate portion of it. So it's kind of the same thing in that core sense, but even it's more specialized because the type of labor that's required, licensing, and these are highly regulated facilities, right? But nonetheless, with COVID, some of them were saying that basically because they had went through COVID, they kind of created the procedures and formulated plans that hopefully with the Delta variant they'll be more prepared. With that being said, as I said on the last video, I think because there's an experience part of it, people will know what to do, especially from an investment standpoint. You just gotta have more reserves for COVID, for non-payment of rent, more reserves for operating expenses, cleaning, all that good stuff, pay. Because one thing they did mention from all the stuff I was listening to and reading to on these webinars was that they are having a hard time, which most businesses are, of retaining and keeping talent, especially those facilities that are on the lower end that are not our public pay, not necessarily private pay, because the restrictions of rents, and then the restrictions of the individual, so they can't necessarily charge a lot more in order to entice the type of workforce, through incentives of pay. So what some have been doing is working to encompass the community portion to help recruit and retain their talent, because what they realized was from the surveys of their workforce was that a lot of the people love working working with the residents, and love to communicate, have conversations and all that. So that was an enjoyable aspect. So working a way to actually incorporate more of that, thinking of other options and opportunities outside of the financials to try to compensate and have them be more part of a community. It's what they've been trying to leverage. to at least retain and try to recruit. But again, you know, more reserves. 'Cause even when I look at affordable housing, all these properties I'm looking at now, I mean, you'll see the line items for COVID reserves, and what they've been putting set aside or actually had experience. I mean, it's roughly around 1% of the gross rental income that they're receiving, right? So that's something to keep in mind, something to prepare for. But you know, all in all, they said that they still see that with the main drivers of senior living happening, I mean, in the next 2 to 3 years, you're gonna have a huge influx of those that are, 70 plus, and then as well as the population that's 85 plus. Because if you remember, there's a huge, they call them the baby boomers for a reason. I mean, that's a huge population of people that's gonna be turning older and older here over the next several years. So the demand for them, now what that looks like, may change and vary. Some people are trying to have flexible situations and buildings for that, and the platform to accommodate, you know, the overall changes that happen gradually. As I know, one of the guys were stating how they're kind of doing their properties, trying to have more outdoor seating, outdoor recreational, more wellness programs. They wanted to get away from like the dependence factor, because they're saying that most of their tenants want to feel the independence, that for those who can still move around, having options, doing things they don't, because the biggest thing is they don't want to feel isolated, right? As you get older, you know, death becomes more of not necessarily certainty, but it becomes more frequent amongst, you know, their friends and stuff like that. So, and then, you know, their kids are older, they're empty nesters and stuff like that. So, you know, the feeling of isolation is something they're trying to avoid. So creating a community will work. But yeah, hold on. Sorry about that. Well, I lost my train of thought. But so from an investment standpoint, let's get to that. We know the demand is going to be there. The demand is growing. We know that this in certain niches of senior housing requires, you know, specialty providers. So that's where you're definitely building a team is very, very important. Trying to, locate the best operators is very, very important, especially if you decide you want to get into the assisted living, memory care, and skilled nursing. And then definitely, that's one of those things I believe you have to be truly involved in, be part of the community, go to all the events, network with all the, not only the brokers, but the operators, the lenders, the experts, so you understand what's coming down the pipeline, the laws, the demands. But also, I think, well, that's with anything, being very conservative in your underwriting will be key. Because I don't think, like I said, well, especially I'm in Texas. I don't know where everybody else is at. But I don't think, like in Texas and Florida, I don't think they're going to do any type of lockdown. I may be wrong, but I think the chances are very slim, especially after the whole debacle, the way it's been politicized. The news of the variant, the way it's spreading is real, in my opinion. Because I mean, just like any virus, I mean, their job is to replicate and survive. So they're going to continue to do what they do. So it's something I think that's going to be around for a while. But I think that being that we've been through it and kind of seeing how certain assets behave can allow us to kind of plan for it and just be more conservative about it. And then figuring out, back to the demand portion, you know, in my opinion, what has one of those demand drivers that's going to be consistent for years to come, because you're investing for the long term. It's not just a short-term trend. This is something that's going to be a long-term trend, because, you know, I'm thinking long-term, we're thinking cash flow for not only ourselves, but for the investors that we take money from. So Do I still think opportunity is senior housing based on what I've been listening to and hearing? Yes, everybody believes it. Like I said, everybody's making sure they have the procedures and policies in place, revisiting them, mask. Now, the controversy comes to where they have been having a discussion, should they be mandating that their employees get vaccinated in order to work there to protect everyone, because they do anticipate there will be some type of outbreak. So they want to protect everybody as best as they can, lower the chances of that. So that's one thing to consider, knowing that the operation part, it may be operating expenses of the business might be a little bit higher, especially with them needing to, like I said, with everybody is experiencing, especially in the restaurant industries and other industries, a shortage of qualified workers. Just with the way that the pandemic has kind of played in the employment industry. Everybody's looking for talent. There seems to be a shortage of it. It's requiring people to pay more, up their game and whatnot. So just to anticipate for that. But like I said, it's one of those demands that's not going to change anytime soon, because there's such a huge population of people that are going to be turning old. They're going to, want to seek some type of independence, or on the other end of the spectrum, they're going to need some type of care. And then it's just figuring out where you guys will fall in on that, and really understand. Because like I said, it's licensed and regulated, especially when you get to the memory care. So what I did read an article, and this was prior to when I even started. After talking to people, trying to get an idea about senior living, and just hearing people come to me because I'm in real estate looking for somewhere to live, and just pique my interest and say, well, man, there must be a greater demand than I thought, and a greater need for it. So which means it's an opportunity to serve, right? But partnerships will be key, because like I said, on that end, you're talking about people that are official operators of the business, and us just being the actual owners of the real estate, right? And working through that through a master lease agreement or whatever kind of joint venture agreement you want to consider. But nonetheless, I think being prepared, especially in the underwriting, reserves, raise as much money as possible. Because the one thing, when I listen to these guys, and they tell you, it's really not a good look to raise money and then come back to your investors for another raise shortly thereafter. So it's best to just, even though there's a cost to that too, especially if you're offering the preferred, but we'll get into that some other time. Raise as much money as you need. You can always get the money back, and just prepare. Be conservative. Do your due diligence. Look in the area, especially if you're going to go into the sectors where you want to depend on more of the private pay. The area, 3 to 5 miles. They're saying about 100K plus, 350 plus in home value. The area median income of the kids that are actually going to be help assisting their parents, because they're going to be one of the biggest drivers in making the decision, especially if their parents are older, for them to actually go into some type of senior housing establishment, right? So all those things are going to be key, and then obviously the amenities around and so forth and so on will be a big issue. But if you're like me, when I'm thinking more of affordable and just kind of highlighting and staying in that same realm, looking at a model where these guys are doing 70% senior, 30%, younger renters, to have more of a mixture of not only tenants, but income. It's not age restricted, but it's majority older people there, and facilitating a blend of activities and things for those majority of the tenants, to help with balancing that income portion. Like I said, I think the affordable crisis is going to go through all sectors, especially on the residential side, living side. So I think that's going to be one of those ongoing trend demands for years, maybe life. I don't know. But that's kind of the area I'm thinking about playing, and it's just because knowing that there's probably a huger population of people that look for affordability versus on the other one that's luxury, lifestyles, has money. So there's more demand there. Then it's just about figuring out and being great at operating, be great at creating a community, being great at creating a great experience for people to want to stay, working with the local communities and governments to make sure that the people that need the assistance get the assistance. The Section 202 for seniors that will help, basically pay majority of their rental costs, so they won't pay no more than 30%. And then the rest of, they have to use whatever assets and stuff like that, which I think is probably more reasonable in most instances, as opposed to where, they're going to more luxurious locations. You know what I mean? All those amenities. So that's just kind of recap. Some brief stuff I wanted to throw out there. I told you guys I was going to go back and look, do some due diligence, see what's going on in that market. Since we were talking about the Delta variant, how that's going to be an impact. Maybe there's opportunities that's going to be created. Understanding some of the risk, but paying attention that there is opportunity there. So, as always, like, share, subscribe, leave a comment. Let's continue to have this conversation about investing. As I tell you all the time, I don't know everything, but I'm willing to learn. This is a platform to learn, so we can share experience, share knowledge, share resources, share our networks. For the ultimate goal is to acquire commercial property, right? Income producing property, that is. So we can fund things that are most important to us: friends, family, charities, missions, you name it. But like I said, we can do it here on this platform, working together, collaborating, doing more with less. As I say, it takes a village. We can be that village, and that's the platform that, hopefully it can be. So to do that. So again, like, share, subscribe, leave a comment. If there's anything else on that topic you guys want to talk about. If not, please share. Join the Facebook group. Let's continue the conversation offline. And then I guess I'll see you guys next Wednesday. So let's keep talking commercial real estate, black people. Let's get into the game. Until next time, happy investing. Deuce.
These my dollars make it hurt.